There is a number larger than global GDP. Larger than total stock market value. Larger than total government debt. A number so large that it rarely makes headlines. Over $400 trillion. This number does not represent physical cash. It does not represent printed currency. It represents financial contracts, derivatives, interest rate swaps, currency swaps, futures, options, complex instruments layered on top of global finance. These instruments were designed to manage risk, to hedge exposure, to stabilize volatility. But when scale grows beyond comprehension, hedging systems become interconnected. And interconnected systems carry their own fragility. The $400 trillion problem is not about a single institution. It is about network complexity. Financial systems today are layered. Banks hedge against interest rate movements. Corporations hedge currency exposure. Funds hedge portfolio risk. Every hedge creates a counterparty. Every counterparty creates dependency. When dependencies multiply, the system stabilizes in calm periods. But under stress, dependencies amplify. The global derivatives market dwarfs most economic indicators. Yet it rarely dominates public discourse. Because it operates behind the scenes. Invisible to most. But central to liquidity. Central to credit. Central to capital flows. Derivatives are not inherently dangerous. They are tools. But tools at scale become structural. And structural layers alter fragility. The real question is not whether $400 trillion exists. It does. The question is whether the system can absorb stress when exposures interconnect. Because complexity does not break in normal conditions. It breaks under correlation. When many risks move in the same direction. And in a world of rising rates, shifting currencies, and volatile geopolitics, correlation risk increases. This episode is not about predicting collapse. It is about understanding exposure. Because exposure is leverage. And leverage defines fragility. What that $400 trillion actually represents. The number sounds catastrophic. But context matters. The notional value of derivatives exceeds $400 trillion globally. Notional value does not equal actual loss potential. It represents the face value of contracts. For example, an interest rate swap may reference $100 million in debt. But the swap itself is not $100 million of cash. It is an agreement to exchange interest payments based on that amount. The net exposure may be much smaller. However, gross exposure matters when systems interconnect. Derivatives are used to hedge. Banks hedge fixed-rate debt exposure. Corporations hedge currency risk. Funds hedge market volatility. Without derivatives, financial markets would be less stable. But hedging creates counterparty chains. If Bank A hedges with Bank B hedges with Bank C. Bank C hedges with a clearinghouse. Risk becomes distributed. Distribution reduces individual volatility. But increases systemic interconnection. In stable markets, this network functions efficiently. Clearinghouses net exposures. Collateral requirements reduce default risk. Capital buffers absorb shocks. But complexity increases correlation sensitivity. If interest rates rise sharply, derivative valuations shift. If currencies move dramatically, margin calls increase. Margin calls require liquidity. Liquidity demand increases funding stress. Funding stress pressures asset prices. Asset price declines increase collateral requirements. Collateral requirements trigger further selling. This is how feedback loops form. Derivatives are not bombs. They are amplifiers. They amplify movement. Under normal volatility, amplification is manageable. Under systemic stress, amplification accelerates. The 2008 crisis demonstrated how derivative exposure can cascade. Credit default swaps linked institutions. Mortgage-backed securities linked banks. When underlying assets declined, hedges failed to offset systemic panic. The lesson was not that derivatives are evil. It was that opacity increases fragility. Transparency has improved since then. Capital requirements increased. Clearinghouses expanded oversight. But scale has also expanded. Interest rate derivatives now dominate exposure. As rates rise after long periods of suppression, valuation swings increase. Small rate changes applied to trillions in contracts produce large balance sheet adjustments. Those adjustments require liquidity. Liquidity is the oxygen of financial systems. When oxygen thins, stress spreads. The $400 trillion number represents scale. Scale does not guarantee collapse, but it increases sensitivity. Sensitivity means smaller shocks can travel faster. And faster shocks require faster policy response. Liquidity, leverage, and the illusion of control. Derivatives are often described as risk management tools. And in isolation, they are. An airline hedges fuel prices to stabilize costs. A multinational corporation hedges currency exposure to reduce volatility. A bank swaps fixed interest for floating interest to balance balance sheets. Each transaction appears rational. Each transaction reduces localized uncertainty. But modern finance is not isolated. It is layered. When risk is transferred, it is not eliminated. It is relocated. And relocation across a dense network changes system behavior. The central variable in this network is liquidity. Liquidity determines whether obligations can be met in real time. In derivatives markets, positions are marked to market daily. If valuations move, collateral must be posted. If collateral cannot be posted, positions are liquidated. Liquidation affects prices. Price movements affect other positions. Other positions trigger additional collateral calls. This dynamic is not theoretical. It is mechanical. The scale of global derivatives means even modest volatility can trigger large collateral flows. When interest rates rise quickly, bond prices fall. Falling bond prices affect interest rate swaps. Swap valuations change. Margin calls are issued. Institutions must post cash or liquid assets. If institutions do not hold sufficient liquidity, they must sell assets. Asset sales depress prices. Depressed prices affect other portfolios. This is leverage in motion. Leverage magnifies impact. In low-rate environments, leverage appears stable. Borrowing costs are low. Asset prices are high. Volatility is subdued. But leverage embedded in derivatives amplifies changes when conditions reverse. The illusion of control comes from netting. Clearinghouses net exposures. Banks report reduced net derivative risk. Risk appears contained. But netting assumes counterparties remain solvent. If a major participant fails, gross exposures matter. Gross exposures reveal the true scale of interconnection. Post-2008 reforms centralized clearing. This improved transparency. But it also concentrated risk within clearinghouses. Clearinghouses became critical nodes. Critical nodes require liquidity backstops. Backstops often depend on central banks. Central banks provide emergency liquidity to stabilize funding markets. This works in crises. But repeated reliance on central bank intervention reshapes incentives. Market participants may assume backstops will exist. Assumptions influence leverage decisions. Leverage decisions influence exposure growth. Exposure growth increases dependency on liquidity support. The system becomes more stable in calm periods and more dependent on intervention during stress. Now consider rising interest rates. For over a decade, global rates remained historically low. Financial institutions structured portfolios around that environment. When rates began rising rapidly, valuation adjustments cascaded. Bond portfolios declined. Swap positions shifted. Pension funds in some markets faced margin stress. Institutions had to mobilize liquidity quickly. Central banks intervened to stabilize specific segments. This demonstrated how sensitive leveraged structures can become when regimes shift. The $400 trillion problem is not about notional value alone. It is about regime change. If financial systems are optimized for low volatility and low rates, sudden shifts create imbalance. Derivatives amplify regime transitions. Another factor is cross-border exposure. Currency swaps connect banks across jurisdictions. Emerging market borrowers hedge dollar exposure. Dollar funding shortages can propagate globally. If dollar liquidity tightens, funding stress spreads internationally. International coordination becomes essential. But coordination is complex during geopolitical tension. Financial globalization increased efficiency. It also increased transmission speed. Speed reduces reaction time. Reduced reaction time increases stress probability. Now consider shadow banking. Not all derivative exposure sits within traditional banks. Hedge funds, private equity firms, insurance companies, non-bank financial institutions. These actors often operate with leverage but without identical regulatory frameworks. Their exposures connect to banks through financing agreements. If non-bank institutions face margin stress, banks may experience counterparty risk. Counterparty risk influences credit availability. Credit availability influences economic activity. Economic activity influences corporate earnings. Earnings influence asset prices. The system loops again. The illusion of control persists because risk appears distributed. Distributed risk feels safer. But distribution increases complexity. Complex systems do not fail because one component is large. They fail when components interact under stress. Derivatives create interaction channels. Interaction channels are efficient in calm periods. Under stress, they propagate movement. Liquidity is the key stabilizer. As long as liquidity is abundant, stress dissipates. If liquidity tightens, stress amplifies. Central banks can inject liquidity. But repeated intervention shapes market expectations. Expectations influence leverage appetite. Leverage appetite influences exposure growth. Exposure growth increases systemic sensitivity. This cycle does not guarantee crisis. It guarantees conditional stability. Stability depends on liquidity. Liquidity depends on confidence. Confidence depends on perceived solvency and coordination. In a world of elevated debt, rising rates, and geopolitical fragmentation, confidence can fluctuate. Fluctuation increases volatility. Volatility increases collateral movement. Collateral movement increases liquidity demand. Liquidity demand tests system capacity. The $400 trillion exposure is not inherently explosive. It is structurally sensitive. Sensitive systems require careful calibration. Interest rate normalization. Regulatory oversight. Capital adequacy. Transparent reporting. These reduce fragility. But scale ensures sensitivity remains. The illusion lies in assuming modern financial engineering eliminates risk. It does not. It redistributes it. Redistribution can stabilize. But it also entangles. Entanglement makes disentangling difficult. When stress emerges, disentangling requires coordination across institutions and jurisdictions. Coordination is not automatic. It depends on political alignment and policy capacity. The larger and more interconnected the derivative network becomes, the more reliant it is on institutional competence. Competence reduces fragility. But competence must be sustained. Financial systems are adaptive. They learn from crises. They add safeguards. but they also add layers. Layers increase opacity. Opacity reduces visibility of emerging stress. This is not pessimism. It is structural observation. The $400 trillion figure signals scale. Scale signals interconnected leverage. Interconnected leverage signals conditional stability. The question is not whether derivatives exist. It is whether the system can absorb simultaneous stress across interest rates, currencies, and asset prices. As long as liquidity flows and coordination holds, the network functions. If liquidity constricts and coordination falters, amplification accelerates. The scale itself becomes the amplifier. When correlation breaks the system. Financial systems are designed to manage isolated risk. Interest rate risk, currency risk, credit risk, commodity risk. Each can be hedged. Each can be offset. Each can be distributed. But systems become fragile when risks move together. Correlation is the hidden accelerant. In normal conditions, asset classes behave differently. Stocks rise while bonds stabilize. Currencies fluctuate within predictable ranges. Volatility remains contained. Derivative positions offset localized movement. The system functions efficiently. But during regime shifts, correlation increases. Multiple markets move in the same direction. Interest rates rise rapidly. Equity valuations adjust downward. Currency volatility spikes. Credit spreads widen. When these occur simultaneously, hedges become less effective. Because hedges rely on diversification. Diversification relies on non-correlation. When everything moves together, diversification weakens. Derivatives amplify this effect. Consider a bank hedging interest rate exposure. It enters swaps to exchange fixed for floating payments. Another institution does the opposite. Under stable rates, flows net smoothly. But if rates rise sharply and volatility spikes, valuation swings intensify. Margin requirements increase. Institutions must post collateral. If equity markets decline at the same time, portfolio values fall. Falling portfolios reduce available collateral. Liquidity tightens. If currencies fluctuate dramatically, multinational firms face unexpected exposure. They may draw on credit lines. Credit line usage increases bank funding needs. Funding stress spreads. Correlation transforms isolated volatility into systemic pressure. Now add leverage. Leverage magnifies asset movement. If an institution holds assets financed with short-term borrowing, a small price decline can erode equity significantly. If that institution also has derivative exposure, margin calls compound stress. Forced selling begins. Selling depresses prices further. Further declines trigger additional margin calls. This is the classic feedback loop. But modern systems are faster. High-frequency trading. Automated risk models. Real-time valuation adjustments. Speed reduces human intervention time. When correlation rises, the adjustment process accelerates. Clearinghouses act as stabilizers. They demand collateral to reduce counterparty risk. But higher collateral requirements during volatility require liquidity. If many participants need liquidity simultaneously, funding market strain. Central banks may intervene. But intervention timing matters. If confidence erodes before intervention, contagion spreads. Correlation is not constant. It spikes during stress. Geopolitical shocks. Sudden monetary tightening. Unexpected defaults. Energy price spikes. Each can increase correlation. Now consider global fragmentation. Financial globalization interconnected markets deeply. Capital flows cross borders rapidly. Currency swaps link banks internationally. Emerging market debt often denominated in foreign currency. If the dominant currency strengthens rapidly, foreign borrowers face increased repayment burden. they hedge through derivatives. Derivative hedges require collateral. Collateral requirements may exceed available liquidity. Sovereign stress can emerge. Sovereign stress affects global risk perception. Risk perception affects asset pricing worldwide. The $400 trillion exposure amplifies correlated movement. Because derivatives are layered across markets. Interest rate swaps depend on bond markets. Currency swaps depend on FX markets. Credit default swaps depend on corporate bond performance. If bond yields rise, credit spreads widen. If spreads widen, equity valuations decline. If equity declines, investor risk appetite shrinks. Shrinking risk appetite increases funding costs. Funding costs affect leveraged players first. Hedge funds, private credit funds, non-bank financial institutions. These entities may be less regulated than banks. Their distress can transmit to banks through counterparty channels. Transmission increases systemic stress. Correlation creates domino effects. But domino effects require proximity. Derivatives create proximity. Even if two institutions do not directly transact, they may share clearinghouses or counterparties. Shared exposure creates hidden linkage. This is why regulators monitor concentration risk. If too much exposure concentrates in specific clearinghouses or asset classes, fragility increases. However, monitoring does not eliminate correlation risk. It only maps it. The greater the complexity, the harder it becomes to predict cascading interactions. Financial systems are adaptive. Participants adjust hedges. Rebalance portfolios. Reduce leverage during volatility. These stabilizers work under moderate stress. But under severe correlated movement, speed overwhelms adaptation. Correlation risk is especially relevant during monetary transitions. If inflation remains elevated and interest rates must stay high longer than expected, long-duration assets suffer. If long-duration assets decline while funding costs rise, leveraged positions compress. Compression triggers deleveraging. Deleveraging affects asset prices broadly. When asset prices decline broadly, correlation spikes. The 2008 crisis revealed how correlation can jump unexpectedly. Assets previously thought independent moved together. Liquidity evaporated. Confidence collapsed. Since then, capital buffers increased. But buffers are finite. And scale expanded. Correlation risk is not inevitable. It is conditional. But the larger and more interconnected the derivative network becomes, the greater the potential amplification. The $400 trillion exposure is not about one catastrophic event. It is about sensitivity to correlated stress. If interest rates normalize gradually and markets adjust smoothly, derivatives function as designed. If shocks cluster, amplification increases. We must also consider technological acceleration. Algorithmic trading systems respond to volatility automatically. Risk parity strategies rebalance mechanically. Volatility targeting funds adjust exposure based on market signals. If volatility spikes, algorithms may reduce exposure simultaneously. Simultaneous reduction increases price movement. Price movement increases volatility. Volatility triggers further reduction. Automation adds speed to correlation. Speed reduces reaction time. Reaction time matters during stress. Central banks can slow panic through liquidity injections. But coordination across jurisdictions becomes complex during geopolitical tension. Fragmentation reduces collective response efficiency. Reduced response efficiency increases stress persistence. The derivative network is like a circulatory system. It distributes financial flow efficiently. But during shock, circulation can accelerate in destabilizing patterns. Understanding correlation risk does not mean predicting collapse. It means recognizing amplification pathways. Systems that appear stable under isolated stress may react differently under clustered shocks. Clustered shocks test resilience. Resilience depends on capital, liquidity, transparency, and coordination. The $400 trillion figure highlights scale. Scale combined with correlation creates potential fragility. But potential fragility is not destiny. It depends on shock structure and policy response. Modern financial systems are stronger than pre-2008 in capital adequacy. But they are also larger and more interconnected. Interconnection increases efficiency. It also increases sensitivity. The question is not whether derivatives are dangerous. It is whether systemic coordination can match systemic complexity. If complexity outpaces coordination, fragility rises. If coordination evolves alongside complexity, stability persists. Correlation is the hinge. And in an era of monetary tightening, geopolitical realignment, and energy transition, correlation risk cannot be ignored. Why this doesn't collapse overnight? When people hear a number like $400 trillion, the instinct is panic. It sounds unsustainable, uncontrollable, explosive. But scale alone does not cause collapse. Structure determines outcome. Modern financial systems are fragile in some ways, but they are also resilient in others. To understand the $400 trillion problem properly, we must examine both. First, capital buffers. Since the global financial crisis, banks have increased capital ratios. Stress tests became routine. Liquidity coverage requirements tightened. Central clearinghouses expanded oversight of derivatives. This reduced opacity. Increased transparency improves monitoring. Second, netting mechanisms. Clearinghouses offset exposures between counterparties. Instead of every contract existing in isolation, positions are netted to reduce gross exposure. This dramatically lowers immediate loss potential. Third, central bank backstops. When funding markets tighten, central banks provide liquidity. Repo facilities, swap lines, emergency lending windows. These tools stabilize short-term funding. Liquidity support prevents forced liquidation spirals. These safeguards matter. They reduce the probability of sudden systemic collapse. But safeguards do not eliminate risk. They transform it. The system becomes more dependent on policy competence. As complexity grows, reliance on central coordination increases. If coordination functions smoothly, stability holds. If coordination falters, fragility emerges. Another stabilizer is diversification of exposure. The $400 trillion is spread across jurisdictions, across asset classes, across institutions. Not all positions move in the same direction. Many offset each other. But this depends on correlation remaining contained. The real vulnerability appears when multiple shocks cluster. Not one event, but overlapping pressures. Imagine a scenario where interest rates remain elevated longer than expected. Credit spreads widen due to slowing growth. Currency volatility increases from geopolitical tension. Energy prices spike. Each alone is manageable. Together, they increase collateral calls and funding pressure simultaneously. Even then, collapse is not automatic. But stress accumulates. Institutions may reduce risk. Asset prices may adjust. Volatility may increase. The system tightens. Modern crises often look like liquidity squeezes, not structural implosions. Liquidity squeezes can be resolved with intervention. But repeated intervention has consequences. Frequent support can distort incentives. Market participants may assume that risk is socialized. This moral hazard encourages leverage. Leverage increases sensitivity. Sensitivity increases future dependence on intervention. This is the quiet trade-off. Stability today may increase fragility tomorrow. The system does not collapse because of size. It becomes more reliant on active management. Active management requires credibility. Credibility depends on institutional strength. Another factor preventing sudden collapse is economic interdependence. Major financial institutions are deeply connected to real economic activity. Governments have strong incentive to prevent systemic breakdown, because collapse would disrupt employment, trade, and political stability. This incentive motivates rapid intervention. During recent market stress events, policymakers acted quickly. Liquidity facilities were activated. Emergency lending programs launched. International coordination strengthened. Speed matters. The faster the response, the less damage spreads. But speed depends on trust. Trust in central banks. Trust in regulatory frameworks. Trust in fiscal sustainability. If trust erodes, intervention effectiveness declines. The $400 trillion derivative structure is sustainable as long as confidence holds. Confidence is reinforced by orderly markets. Orderly markets depend on credible policy. Policy credibility depends on economic fundamentals. And here is the deeper layer. Derivative exposure exists within a broader macro environment. High global debt. Rising interest rates. Geopolitical fragmentation. Energy transition pressures. Labor market shifts. These macro variables influence financial stability. Derivatives amplify volatility within that environment. They do not create it independently. This distinction is important. The $400 trillion problem is not an isolated bomb. It is an amplifier inside a leveraged global system. Amplifiers increase the effect of shocks. But they do not create shocks themselves. The system collapses only if multiple safeguards fail simultaneously. Capital buffers. Liquidity support. Clearinghouse integrity. Policy coordination. Institutional credibility. The probability of simultaneous failure is low, but not zero. And that is where fragility lies. Fragility is not imminent disaster. It is conditional vulnerability. Conditional vulnerability increases when complexity rises faster than transparency. When leverage rises faster than capital. When political fragmentation rises faster than coordination. The modern financial system is sophisticated. But sophistication increases dependency on management. In simpler systems, failures are localized. In complex systems, failures propagate faster. So why does the system not collapse overnight? Because institutions adapt. Because policymakers intervene. Because capital buffers absorb moderate shocks. Because netting reduces direct exposure. Because incentives align to preserve stability. But preservation requires vigilance. The real issue is not whether $400 trillion triggers collapse tomorrow. It is whether systemic sensitivity increases over time. If leverage grows quietly. If liquidity becomes more fragile. If confidence erodes gradually. Then stress events become more frequent. Each stress event may be resolved. But repeated resolution reshapes long-term structure. The modern financial system is not on the edge of instant collapse. It is operating within tight margins. Margins depend on trust and liquidity. If those margins shrink, volatility increases. Volatility tests coordination. Coordination tests credibility. Credibility sustains stability. The $400 trillion number is not a prediction. It is a scale indicator. Scale indicates interconnected leverage. Interconnected leverage indicates amplification potential. Amplification potential indicates sensitivity. Sensitivity demands competence. And competence determines outcome. This is not a doomsday narrative. It is structural awareness. Financial systems survive by adapting. The question is whether adaptation keeps pace with complexity. That is the real issue no one wants to talk about. The $400 trillion number is not a countdown clock. It is not a hidden bomb waiting to explode. It is a scale indicator. A signal of how interconnected modern finance has become. Derivatives are tools. They hedge risk. They stabilize volatility. They allow institutions to manage uncertainty. But when tools scale across hundreds of trillions of dollars, they stop being peripheral. They become structural. Structure creates efficiency. It also creates sensitivity. The system does not collapse because it is large. It strains when shocks cluster. When liquidity tightens. When correlation rises. When confidence weakens. Modern safeguards are stronger than in the past. Capital buffers are larger. Clearinghouses are centralized. Transparency is improved. Central banks have powerful liquidity tools. These layers reduce the probability of sudden breakdown. But they increase dependency on coordination. And coordination requires credibility. The real risk is not size alone. It is complexity interacting with volatility. A tightly connected financial system can absorb moderate stress. But it requires constant calibration. Policy competence. Institutional trust. Liquidity management. If those hold, stability persists. If they weaken, amplification accelerates. The $400 trillion problem is not about predicting collapse. It is about understanding exposure. Exposure shapes fragility. Fragility shapes response. Response shapes long-term structure. And structure determines economic resilience. In the next episode, we shift from financial plumbing to geopolitical strategy. Because liquidity, leverage, and derivatives operate within a currency system dominated by one force. How the US dollar quietly took over the world. To understand systemic stability, we must understand currency power. If you want to see how technology, labor, debt, and currency dominance connect beneath the headlines, subscribe. Not for alarm. For structural clarity.